Hello, welcome to Insignia Investments. My name is Rupratim Dotto, and today we are going to discuss about stock price predictions. A lot of claim and fame has already soared this topic from academia to celebrity status. Today, we use an Excel sheet and some statistical tests to check for ourselves how much of this stock price prediction is actually fact and how much of it is fiction. Let's begin. Hey guys, so we just start with a blank Excel sheet, and what I have done here is that I have loaded the prices for Nifty for the last 5 years, the last trading prices from 21st August 2012 all the way to 8th of September 2017. So what's a run test? Let us assume that we have a series of numbers that goes much like this: 1 1 1 2 2 1 1 1. So if this series that consists of only two possible numbers that can be used, this triplet will be called one run, this duplet will be another run, and these three ones together will be another run. So basically this series itself consists of three runs. So we'll see whether these runs that take place together, these amalgamation of numbers together to create these subsets that are together, whether these numbers, this distribution is random or not for these number of observations. Like in this case there are 8 observations, so if there are 8 observations and there is a possibility of having only 2 numbers, we create all the possible scenarios of how these numbers can be distributed in these places, and they will form a normal distribution thanks to the central limit theorem, and we compare our given series against this normally distributed mean distribution. We compare it with the mean and the standard deviation to figure out, standardize it, and then figure out whether it goes against a null hypothesis that there is some randomness in its distribution. So let's get started. To get this executed, we'll start by checking the changes in the price. So we'll say that if today's price is greater than yesterday's price, we'll say it's a +1. Else, if there is no appreciation, we'll say it's a -1. And we'll do it for all the dates. Now to check for these patterns, these runs, we'll use this clause that if today is the same as yesterday, that means I'm in between a run, and hence I'll flag it as a 0, else I'll flag it as a 1, that is a run has ended. So we'll just count how many runs are there by just summing up all the numbers in this series, and we see that this series has 583 runs. So we'll count the number of up moves and the number of down moves. That is our N1 and N2, and these are the numbers that we'll be putting into this formula to figure out whether the number distribution is random or not. So we'll just count the number of ones. Count if this entire series, comma 1, and then count if this entire series, comma -1. So there we have it, N1 and N2. So the total number of observations will be the sum of these two numbers. So we have a total observation of 1249. So if it were normally distributed, the mean distribution would have the expected number of runs as given by this formula is equal to 2 times N1 multiplied by N2 divided by N1 plus N2 plus 1, that is 623. Whereas the standard deviation of this distribution would be the square root of 2 times N1 multiplied by N2 whole multiplied by 2 times N1 multiplied by N2 minus N1 minus n2 whole divided by n1 plus n2 whole squared times n1 plus n2 minus 1. That is 17.59. Now the number of runs that we have got in this case is equal to 583. So we'll just standardize this entire distribution so that we can compare it against the standard normal distribution as z is equal to r minus expected r divided by the standard deviation. So we have a 2.273. So because we have a two-tailed test, the p-value will be equal to 2 times 0.5 minus 2.27 will give me 0.4884. 0.4884. That is at 98% confidence level, I can say that the prices or the changes in the prices are random. So if the changes are random, the prediction of the subsequent underlying prices is also not possible. And hence, we can safely conclude that using a statistical test, we have proved that at 98% level of significance, we cannot conclude effectively whether we can predict prices consistently. But some people will say that at 95% level of confidence, we can reject the null hypothesis and say that there is some pattern to this distribution and calculate the prices. But the catch is, are you willing to bear the 5% risk exposure that you have because you're relying on a 95% confidence level model? If you can bear that much amount of risk, probably this semi-strong form of market will give you the space to predict some prices and make some money out of it. But there will be 5% of the cases where you will lose money and you cannot predict how much money you will lose exactly. And hence we can effectively prove from the perspective of an individual common investor that stock prices really cannot be predicted.
And with that, we come to a conclusive end to our discussion. Stock prices cannot be predicted. But be aware of the fact that there will be certain other models, specifically based on machine learning, where there will be times when certain stock price movements can be predicted, but that's a result of overfitting. So there will be a very short span of time where this model will work, but for all the other expanses of time, this model will be a total disaster. In general, stock prices move randomly, that is, returns are random, and the only thing you can predict is the volatility. I hope so that brings you one step closer to becoming an intelligent investor. And with that, we call it a day. Subscribe to our channel, and if you have any more doubts or any more comments on the same, comment in the section below. And for a conclusive vlog on the same, check out our description below and the card above. Thank you and happy investing.